Hello, I'm Peter Switzer. Welcome to the program which puts you in touch with the best and the brightest minds in business. Tonight is at curtains for Billabong. Simon Bond from RBS Morgans and analyst Roger Montgomery will give us their thoughts on this troubled Aussie icon. First up today, in response to popular demand, two of our favourite contributors, Simon Bond and Roger Montgomery, returned for the first time in 2012, and they're here to help us create the court of public expert opinion on stocks, what to buy and, of course, what to avoid. Tonight, we'll look at some of the heavyweights in retail, DJs versus Myers, Harvey Norman up against JB Hi-Fi, and there's the beleaguered Billabong as well. I'm also going to throw another one as well. Guys, great to see you.
Good to be back.
So, it's funny, over a year, I can't get sick of you, but after 2 months, I missed you. I really missed you. I'm sure the people out there did as well. So
that's very flattering. Thank you very much, Peter.
Okay.
Lovely.
It's probably brutal honesty, but it's exactly what I felt.
I appreciate that.
So it's great to have you back. Let's kick off. And this year, I really want to use your brains to work out what companies we should hang on to and which ones we should just absolutely turf out until it's time to pick them up again.
Okay.
So let's kick off, particularly with DJs and Myer.
Okay.
Flying home from Adelaide, over in Adelaide today, I was looking at the dividend yields. The dividend yields are fantastic on these companies, 10%. How come, Rog?
Well, I remember being on this program with somebody else, and being told, this is a couple of years ago now, and being told that Telstra's yield looked very attractive, and then the share price promptly fell 25 or 30%. So the trick is not to buy based on yield. Looking at both of those companies, structurally, there's a lot of changes going on in their space.
Yeah.
So cyclically, we've got a problem, and that is the consumer isn't spending. Okay, we understand that. We know from stats from the Reserve Bank of Australia that people are spending more money now on debit cards than they're spending on credit cards, so they're not borrowing money. Credit growth from the bank results we know was pretty mediocre. Most of their profits came from a write-back of bad and doubtful debts.
Yep.
And so cyclically, we've got problems. Structurally, we've got even bigger problems. And that is a function partly of the fact that we've got a very strong Australian dollar, but also that people have realised now they can buy products much, much cheaper overseas, and they can do it online. They don't have to pay any GST, and it's all good for the consumer.
The head of enterprise for Google, I heard him speak last week. You love this, being our IT man in the stocks department. And he said most retailers have become the most expensive change rooms in the world, that people
Correct.
are going in, checking out the stuff and checking out on the website. That's really a big challenge for retailers, isn't it?
Well, a store I went to would not, a store I went to over the summer would not let you try on ski boots, snow ski boots, unless you paid $50 first.
Yeah, and what was your
trying the
response
boots
as a consumer?
Well, I wasn't in the market for ski boots, but I just noticed that that's what they were doing. I think they're in a really tough position because they know that people are there to try boots on and go and buy them much cheaper online.
Yeah.
It's just very, very difficult. Myer's intrinsic value has been declining since it listed. The share price has been following. Its intrinsic value is not going to go anywhere over the next 3 years. It's going to go sideways, and it's not trading at a discount to that intrinsic value. So it's structurally damaged, cyclically damaged, it's expensive, and it doesn't look like it's going. Buy a dress for 2 weeks, and then apparently people throw it out and buy another one.
I've never bought a dress for even 1 week.
So you didn't wear the one I got for you?
No.
Oh, that's a shame.
I thought it was a very bad present. Now, so Simon, you said no retailers are worth considering. Roger, you go through companies objectively. He goes through them,
Well, he does too. Just a different way.
Yeah, different way.
Different technique.
But are there any retailers that are coming up with intrinsic value?
Before I came on the program, I pulled up Scaffold and I had a look at all the retailers.
Scaffold is your special...
It's a tool we released in November.
Yeah.
It covers every single listed company in Australia. Yeah. It values them. It puts a quality score on them, A1 to C5.
So basically, when you share with us, it's done on a software.
And everybody can look at it now.
Okay.
So it's Scaffold with a K. Okay. So thank you for the opportunity to mention that.
No, people like you and they like your analysis, so I'm happy to share that with them.
Okay, so there wasn't a retail stock that we saw as being both high quality and trading at more than a 20% discount to intrinsic value, which is what we're looking at if we're trying to find a bargain. So ARB, we like ARB. That's a retail company.
It's a company you've always
liked. It's also a manufacturer. Yeah. It's the bloke stock.
The bloke
We've
stock.
got to mention it every year.
And blokes are sort of dumb. They won't get the internet thing for a long time. They're too busy.
No, I don't think that's true. But you're not going to buy a Bull Bar online. You just.
Won't you?
I don't think so.
Oh.
You got to go in and you got to have a look and you got to pick it up.
There you go.
So you got to have it fitted.
Like a bloke would.
That's right. And so ARB. even though we love it, it's no longer cheap. Oriton's another one. We like what Sally's doing. We've had Sally on the program.
It's kept doing well, hasn't it?
It's done very well.
Retailer,
and what's interesting, their retail store, when I came in, when we had Sally here, and we talked to Sally at the start of last year.
Sally's the CEO, Sally
McDonald.
McDonald, yes.
She's the CEO.
Yeah.
We had her in, we interviewed her together, you might remember.
I think you took over the show, but go on.
Sorry about that.
Yeah.
Their online store was the 5th highest volume trading store. It's now number 1. It's now number 1.
A lot of their success has been their understanding of the new model.
Yes, and they're expanding into Asia, but Sally has embraced what the CEO of Wesfarmers and the CEO of Woolworths hasn't embraced.
Okay. Just as I was driving into the show tonight, and I was talking about that, and they said, well, but you know, Woolworths and Coles are discounting, but their sales, their profits are going up. How are they doing it? And the radio personality said, well, they're obviously charging you more in the store, but he completely ignored the fact that they're drawing businesses from the smaller businesses, like the milk bar, the shops that used to get people for milk. Now they're not getting in for milk because they go to Coles and Woolworths because of that discounting, and they lose all the bread sales and all the newspaper sales that often used to go with it. So small businesses are losing as well, and they're going to be jobs gone as well.
Big third players, it's true of the big third. Look at Metcash. You know, what's its share price done since 2005? It's gone sideways. It's done absolutely nothing.
Well, on that point, can Metcash weather the pressure from Coles and Woolworths?
Well, Simon might be in a better position. I don't think so, but
it has done well as a company, hasn't it? Its yields have been pretty good, and its share price has done reasonably well.
Well, it's gone nowhere.
Yeah.
The share price hasn't gone down, but it hasn't gone up.
It went down and came back.
But if you look at it from 2005 to now, or 2007, 2005 to now, it's unchanged.
Okay. So
I've heard that before, and I agree with that. But then you've got brands like...
had that problem as well.
But then you've got brands like Oakley. You know, you've got brands like Oakley sunglasses. And Dad wears the Oakley sunglasses and the kids want to wear them as well. And the impact on a company like Billabong has been on its balance sheet.
Yeah.
You know, in order to grow, they've had to make acquisitions. Otherwise, their same-store sales weren't growing, so they've made acquisitions. You know, last year they reported a profit of $119 million, but cash flow from operations was 24.
Hopeless. All right, we'll get back. We'll go back to this subject after, and we'll look at the companies individually and see whether they've got any hope whatsoever. Welcome back to Switzer on Australia's Business Channel. We're with two of our most popular guests, Simon Bond and Roger Montgomery, and we're talking stocks to keep and stocks to shove down the you-know-what. Now, guys, in fact, I'm thinking about getting a toilet. You know, and when a company we don't like, we put it in the toilet. We just don't.
Like that, what's that bloke in the United States? Jim Cramer.
He does
Jim Cramer. I'm sure he makes all those sound effects.
Okay,
when he doesn't like a stock.
Well, maybe we know it. Okay, let's go through the companies we've talked about so far. David Jones.
Okay. Well, how about just short answers from me and from Simon?
Okay.
Yes or no?
So David Jones is definitely not a buy. Not even for people who just want to buy.
That yield won't be sustained.
That yield won't be sustained, no. Simon. You
similar story though. The preference shares and the hybrids after the during the GFC. I remember buying the preference shares of a bunch of companies and getting 30%, 40% yields. You know, buying them at $18 and they were issued at 100. And they've all recovered now. So you can get some good stories, but it's got to be because of a market malaise, not because of one particular company's.
And Quintex and David Jones is an unfair comparison in terms of brand names. The question David Jones will survive. It will have to reinvent itself, won't it?
Yes.
It will go through low earnings for a while, and that yield will come down. And eventually, if it reinvents itself with a great brand name, it may well be an online play, whatever it might be. It will recover, but both you guys think it's going to take time.
Correct.
Okay. So Myer is in the same
Myer,
category?
I think, is, you know, I mean, I don't understand why people shop at Myer. What's their offer?
Okay.
You know, that's tough.
Let's go to an important one, JB Hi-Fi, because historically there was a company you liked maybe a year and a half ago, and maybe sometime last year.
In fact, it was only in October that we bought, I think it was in October we bought some shares at around $15.30. We sold them within a couple of weeks at $15.50, and then they had their downgrade.
Okay, so what's your feel on JB Hi-Fi now?
It's trading at its intrinsic value. I think they're going to win market share from Harvey Norman, but both Harvey Norman and JB Hi-Fi are going to lose market share to the internet. And JB Hi-Fi is a maturing business now. They've still got a lot of stores to roll out, but what we're going to discover is that the margin they generate on those new stores won't be as high as the old stores. It's very, very common in Australia to roll out a retail concept. You take the best sites first, and then you've got your sort of second-rate or third-rate sites to fill in the gaps.
Yeah.
But you're not going to get the same return on those
Okay,
those other
JB
sites.
high five, JB high five, Simon? No, you can't get hot for it. So therefore, I guess you're going to be very hard on Jerry, Harvey Norman.
Jerry, when I occasionally...
He's a decent bloke. Be nice to him.
I don't have a problem with Jerry. He has to reinvent the stores like every other retailer.
Yeah.
They have to reinvent
Historically, he's been able to do it. Historically.
I wrote about this just before Christmas, but I went to my wife's mother's group Christmas party. They're still together after 10 years, the mother's group, which is fantastic. And I asked them, I said, you know, what about the retailers and what about Harvey Norman? Nobody shops there anymore. No one goes in there. The stores are old, they're tired, the offer's confused, the range isn't there. They can just go online and buy everything they need. By the way, I bought 80% of my Christmas presents online this year.
Yeah, but you are a modern kind of guy.
Right.
You are a very modern kind of guy.
Did you buy Simon?
I didn't buy any Christmas presents.
Oh, you didn't buy any
Can't
Christmas
afford them.
Okay.
I'm the stockbroker.
You're the stockbroker, the battler. Okay, so, because Billabong is heading for the, you know what, no good?
Well, Billabong's problem is they've got to write down some of their goodwill.
Yeah.
There's no way with the return on equity that they're getting, they can justify the goodwill that they've got from making the acquisitions that they made.
Right.
They haven't performed, they've got to write those down. So there's a big write-down coming.
Okay.
And because they can't afford what they're spending, the cash flow from operations doesn't match the profits. There may even be a capital raising.
Okay, now, a viewer asked me about Campbell Brothers. Not well known to everybody, but, you know, a $50 plus stock, yield of about 3% or something like that. What do you guys think? What's the scaffold telling us?
Well, I've pulled it up on scaffold. They have
March,
I think they've got a March year end. March year end. So, so their intrinsic value at the moment is 31.13. So remember, we're trying to find bargains, absolute bargains.
So it's over the odds, isn't it?
In fact, the only time it's been cheap was in 2005 and 2008, 2009.
Yeah.
The rest of the time it's traded very, very well above intrinsic value. But that intrinsic value jumps after March to 45.91. So it's trading at, where's it trading? It looks like
about $50.
About $51 or $52.
Yeah.
So you know it's got to drop 10, 15% for me before it's of interest.
Yeah, and you'd like to see the yield better. If you're going to buy a quality stock that doesn't have a real upside according to your figures,
can I just
you'd want the yield to be at least 5 or 6, wouldn't you?
Well, I don't know about that. I think if a company can keep all of its profits and get 30-40% returns on its incremental equity, the retained profits, I'd rather they keep the money than give it to me. What am I going to do with it?
So you're saying Canberra may have the potential over the next 2 or 3 years to go $60, $70?
Well, I've got the return on it. I've got the intrinsic value rising to $50 in 2014.
Okay.
So it's trading at
still
about...
a bit of a wait, but still a good company. Guys, thanks for joining us. But hang here. I'm going to talk about Facebook. Guys beside me have a view on Facebook. Roger, quickly, we are running out of time. What's your view on Facebook?
Very quickly, you're buying the A-class shares if you can get any at all. There's only apparently a maximum of $5 billion on offer. If it's a $100 billion company, they're only issuing 5% of the stock.
Yeah.
You're only getting the Class A's. There's 1/10 of the voting rights of the Class B's, and Zuckerberg and all the executives own Class B's. You're going to suffer massive dilution as soon as you buy the stock, and I reckon it's worth at the most $27 billion, and if they floated it at $100 billion, it's very, very expensive. And even in 3 years' time, I've got an estimated valuation of about $50 billion. So at the moment, you haven't got all the information about to value it on a per-share basis. It's not in the S1. They're filing the IPO. Simon says is actually in the prospectus that they have hundreds of lawsuits against them constantly, and they don't expect that to change. So hats off to Mark Zuckerberg. I mean, he's built an enormous company. Yeah,
for sure.
At a very young age.
Yeah, exactly. Now, Jason Jordan from PC Guru, thanks for joining us, mate. And thanks for your observations. And thanks to you two guys for sharing your wonderful thoughts on stock markets and stocks that we love to buy and sell.